They have a conveyor belt between Japan and America, low-cost funding available in Japan, and then unicorn tech oligarchy that they're building the surveillance society on, and yield margin differentials such as T-bills to Japanese. So that conveyor belt can't be allowed to break down. The conveyor belt of cheap funding is not operating nearly as well, and that there's likely to be a disorderly event of downside here. And people are sleeping on the carry trade threat. They thought, that's it, we did it recently, that means we've released the pressure, it's no longer there. You didn't let the whole thing play out, even for 5% of what needs to play out. The peak crisis of this economic recession that we're already in and have dipped in and out of for quite an extended period is still to happen.
Welcome to the Microscopic Podcast presented by GoldRepublic. My name is Alexei Joranov, and in this format I invite you to look at the world through different lenses to see what's hidden in plain sight. I hope you will get fresh insight and enjoy this conversation. If you do, as always, please give it a like and subscribe, but also leave your actions down below in the comment section and share it to those who need to hear this. But before I start, I'd like you to know that if you open an account at GoldRepublic, you will receive 1 free gram of gold. Just click on the link in the description. Today I have the great pleasure of welcoming back a friend, Francis Hunt, the market sniper. It's always a great pleasure to talk to you. Last time we talked to each other was actually off camera. It was in Cyprus. We had the pleasure of seeing each other over fish. And now this time we'll talk about markets and all kinds of other serious things. Welcome back, Francis.
Delighted to be with you again for more fishy business.
Your pun is always appreciated. I love puns and dad jokes. People who know me know that as well. If we look at the time frame that we had since we last spoke on record, it was the 28th of April, and since then things, as always, and especially in 2025, keep on happening. And we've had, obviously, the escalation of the Israel-Iran conflict, record prices in the last 10, 15 years in silver, platinum. We'll dive into that more precisely. And we've had also strong moves in oils and commodities. But first of all, I'd like to take your analysis of the current conflict that we've seen unfold in the Israel-Iran war. How do you assess this? And more specifically, how do you see the impact it has on markets? Is this over? Is this temporary? Like, how do you see this effect now on the medium term?
So even pre-election, we predicted Trump would win, and that one of the key conflicts that he would undertake would be the one Israel's always wanted, which is with Iran. So this is as expected for us. Funny enough, I was watching some mini clip on X, and it was Jesse Ventura, I think it is, saying, politics is pro wrestling. So there's all this posturing about how angry Trump is with Israel, or that breakup with the relationship with Benjamin Netanyahu. This is all theater, kabuki theater, for people that have intended to do a certain series of events that was preordained, regardless actually who would have been president, but Trump was chosen to be the guy to act out that role. So I mean, it sounds a bit conspiratorial, but this is 100% par for the course. I don't actually see this as a big, as yet, World War III moment. A lot of people want to go full doomer and just go, that's going to be a bunch of nations all launching nuclear missiles on each other. I don't see that. I see this fizzling out into an uneasy ceasefire that can be re-warmed up again, like much like after Putin responded to the Maidan flipping of a democratically elected president by coming in to defend the citizens of Donbass and other Russian ethnic areas that were being bombed by, fired upon by Zelensky. It heats up, it's a major news flash, and then it dissipates. And in fact, we've continued to talk about our gold versus oil trade, which is a gold long, oil short. And actually, that trade has given alpha on the short side. When we put it on, gold was $82. And many people said, why didn't you just have the gold long? Well, they missed the point. We actually have made money also by being short oil from $82. So that was put forward about 18 months ago. I'll have to check the exact dates again. And it has continued to provide alpha. And you saw on the Sunday open, massive gap up. And we said that's an exhaustion gap on balance of probabilities. And I would short the spike, was my knee-jerk response. And what's actually happened is it's crashed, closed the gap, continued to sell off. And it's probably worth giving everyone an update on that. It's down at 65 again. So once again, there's two things about giving a long short trade. One, you make yourself neutral to inflation. So if you all have sudden rage in inflation and gold is running only on account of inflation, you will lose on account of oil should match that. But we really suspect that the global economy is actually in a very deep, broad recession, and that it has potential to actually escalate to get a lot worse. That is why these ready-to-go conflicts to create a bit of heat, a bit of bid in oil, a bit of military industrial complex spend, because a lot of people will have emptied the larder of aging munitions. Ammunition doesn't last forever, and also technology advances. So, you know, there was a lot of talk about Iran actually initially for the Iron Dome using all the old gear and getting the Israelis to expend all their missiles, protecting them on less than modern technology. And then the hypersonic stuff started to come out, and some of the narrative about an Iron Dome has not held up. There's a lot of destroyed buildings. There's a lot of Israelis that have gone to Cyprus. In fact, Israel's tried to almost prevent people from leaving. So, you know, there's so much misinformation. But overall, we look at the charts, and that's where we feel we get the truth. And if I'm comparing the two commodities that should go up on an inflationary environment and a fiat debasement environment, one is a full-blown reserve asset and probably the last one standing after all the others committed suicide, which is referring to debt and the 40-year bull market in debt, in our opinion, being deeply over. And that's last 4 years of a 50% off, clearly reserving that. No reserve asset should lose 50%. You know, you're getting into Bitcoin territory in a bear market there if you're dropping that much. And so we think it's all about reserve asset status, which consistently sees us lean and favor the precious metals and not the energy-based complex nearly as much. Although in the long run, they will come around. When you force the global economy into the kind of recession that we're in my view, we've already met the criteria once before. We've probably dipped in and out America for quite a while. That's what should happen. So that's our view. The retail part, we use the twisted balloon analogy, the retail part of the economy is in recession. So they're pumping heat into the conspiracy half, if you want to call it that. That's the military industrial complex and others. And of course, all the hyenas feast on that carcass and not us. So that's my modeling for where we are.
Now, because you've obviously mentioned it's a recurring topic, and it's something that is obviously ongoing as a slow tanker, as many call it, is the situation in the U.S. bond markets that keep being and showing elevated interest rates, especially in the 10-year, that don't seem to actually go down. One of the things that Trump tried to do in one of his policies is to actually keep the 10-year lower. How do you see this develop? And you've also made analysis about other signals like the Swiss franc and the Japanese yen, which we'll touch upon later on. But let's start with the 10-year.
Yes, here is the 10-year. Let's show it. Overall, our expectation is that you're going to range trade for a while before breaking out to the upside. And it's going to be a lengthy range trading session. But overall, if you're talking about the macro, we're going higher on the basis of a debt-based collapse. So, you know, we've spoken about that absolute high, which was through the 5% mark on the 10-year. We've largely characterized this as one long contraction. You had a very brisk deep into the 4.8s, and now we are in a congestion where we're probably going to bias slightly to the downside. We might even test the 4 and pop below, but in the longer term, we're expecting maybe this is our most common and typically enjoyed upside, and this will mean debt devaluation, by the way, that I'm drawing here in the pink. So that would probably set up something like that. So there's nothing immediate now as a trade, but overall, you've defined a range at the absolute lowest point of 3.6 and at the absolute highest point so far at 5. And we see ourselves tightening in that range, which will eventually become 4 to 4.8. So there was the 4.8. You clearly ran the 4 there. We're going to see a bit more of tightening inside the range before some winding up process. So what's actually happened is debt, US debt, as a devaluation trade is in a holding period, but we've had during this point quite a lot of dollar devaluation during this period. So as I always say, it's a geyser that has too much pressure in it, a lot of steam, and someone's heating it underneath with a fire, and it has two release valves, the currency and the actual valuation of the debt itself. So when you have that happen, you want to you've devalued the debt. It can't become a one-way trade because everyone declared they short. So once it's all been made public that everyone's short debt, it's no longer the trade for now, for a while, until everyone forgets and chases the new thing. So the currency has been the trade. And if we put the dollar underneath it during this period, since November of 23, you'll see that the dollar hasn't performed very well, and it's actually been the release valve for devaluation quite extensively. So instead of the Korean won, we can put the Dixie in there, for example, or even the euro, which is the 52% of that Dixie and is a trade alternative. What you're actually seeing is that since this period roundabout here, we've gone higher. And very particularly since the tariff tantrums of January and the peak tariff tantrum of April. You've seen, so if I just remove those other draws and go back and highlight this, here's the most damaging period of recent for the dollar, the euro USD going up. And you can see that was peak weakness of the euro. And overall, if you look since this period, largely we have traded higher. So, and don't forget, that's against a flawed currency. That is the euro, which has a lot of the same issues, debt as well, just not as high a percentage. And percentage on the debt market is, I would say, the tendency for people to price in default or financial repressionary tactics for that debt market. So we've got an interesting analogy. And I think you were also mentioning you were going to take us to the Swiss franc and the Japanese yen trade that we've been talking about as well. We see the franc has cut on the 19th by a quarter basis points. But the key part that's important in that is they've cut to 0%. And what's actually happening now is you're seeing a polarization in the first world currencies. Those who are most likely to have some form of financial repression and debt-based collapse versus ones that are deemed semi-serious fiats. None of these compared to precious metals, by the way. But if you're looking at it, the Swiss franc is actually one of the strongest, and its central bank has put a zero borrowing cost, and Zero Hedge itself went and said, "Oh, it's all back to ZERP again," and that is wrong. We disagree. This is a polarization. You're not getting ZERP here on the US 10-year, not at all. Yes, it's selling off a tiny bit. You haven't even taken back a third of this 1 week's candle at peak tariff tantrum when both the dollar went down and the rate spiked. So there's nothing too exciting about this. It's dribbling in range. It's not where their action is right now. But the dollar isn't going to ZERP. The Swiss bank that is finding that people that want to hold a transactional fiat where they don't want to go into gold and have to sell straight out, They need transactional money, utility. The closer to liquidity than gold. Gold is liquid, but it's not liquid like you just can, you have a multi-currency bank account with Swiss francs. You can just pay. You can convert it to dollars and just pay. Gold, you still have to call your broker, get a payment order. You have to return it from storage, etc. There's a bit more running in it. So people who are needing utility currency are flooding into the franc. And that's a problem because it's not a massive nation. And that's why they're cutting interest rates. They're basically saying there's no time value to money. You put it at zero, there's no time value to money. And here's a prediction I'm going to make on your channel that we're busy writing up in our newsletter, and you'll be the first to hear it. I'm saying to you, the Swiss will put a negative rate on foreign holdings and deposits in their Swiss banks. Why? Because they want to discourage flight capital coming out of the dollar, coming out of the euro, coming out of the UK and rushing into their banks and wanting a more stable currency. However, causing mayhem on the strength of the Swiss franc, which crushes their ability to export watches and chocolate and everything else that they make. So they have to ugly up a little bit to not over appreciate. And that's how they're going to do it. They're going to discourage particularly the foreign non-resident money. So I'm making a prediction of, never mind ZERP in terms of what they've already done, cutting to zero, but for foreign money at minimum and maybe even domestic, NERP, negative interest rates in the Swiss bank. And that is not the return of ZERP and NERP for a central bank nearby you. It's for countries that are going to survive and have a semi-serious debt position, which is retainable and are high trust societies. America is not one, UK is not one, and the broader trajectory of Europe will indicate that they are clearly not one either. So they are going to get higher, and you're going to get a polarization of rates in the first world. You could also start to see Singapore rates come down, maybe other nations that are very serious nations. I don't know, there's not too many that are out and out sound money, but are less severe cases. But emerging markets are not going to get cheap money, and neither is America ever again. The bond market turned when we called it as a turn, the late end of 2020. And too many people found out, and that's why we're gestating for a while. The longer term is a debt-based collapse model. You break higher, but not for now, technically, if I'm looking at this on a weekly time frame. This could be months, it could be next year, it could take a while. You just look at this on a bigger time frame. I'm just going to hide my drawings that look a little sketchy on the bigger time frames. I'm going to go to log scale. You can see that you should expect continuation. This was final capitulation, end of trend. So what you're getting here is what we've already implied, a pause in an area. By the way, on shorter time frames, we had the exact same, and we called the exact same, and they turned out the exact same way. So we're going to keep on betting in a winning form with a winning hand. That's our template and model. It's called keep on, keeping on. It's continuation as theme. This is just more likely to be a longer period of gestation on the rates. That tells me dollar's going to have a problem on an ongoing basis still, and is going to be patchy, strong, and weak. It's been very weak, but it's going to be patchy in the middle, and sometimes the weakest and ugliest. And that brings in the yen, because they have a conveyor belt between Japan and America, low cost funding available in Japan, and then unicorn tech oligarchy that they're building the surveillance society on, and yield margin differentials such as T-bills to Japanese. So that conveyor belt can't be allowed to break down. Cheap money goes to casino. Cheap money goes to casino. The problem you have is you'll have a nasty unwind when casino breaks, everything go down, money needs to be returned. That's when we'll get a disorderly event on the carry trade. So the carry trade story hasn't gone away, and they need the yen weak to help America, because they can't have the hot flight money that's in the casino have to reverse back to Japan. So I've said quite a lot there. Let me let you unpack some of that.
No, and also coming back to 10-year, there was also, if we bring it back to Iran, they have also, and you retweeted that, it's on your timeline, asking actually Middle Eastern counterparts to start to unload the 10 years US Treasuries, and that we might expect actually more and more from a geopolitical perspective pressure on this 10-year interest rates. But I would like to maybe unpack more on the unwinding of the yen carry trade that you've also covered extensively. And I think it's interesting because it's maybe underappreciated. So why is this pair or the Swiss yen pair so important, and what does it signal?
Yeah, there's a troika. Let's call it a troika. And we chose the Swiss franc JPY for the trade because we expect that the Japanese yen has to be even weaker than the dollar in a period where the dollar is being weak, because they can't allow the debt market to continue to be the obvious short. So it's held in range. And also, there's so many pensions and other funds that have relied on it. So they can't allow that. They have to allow the currency to be weak. But then they have a problem because they've borrowed from another nation that has been running a cheap funding mechanism for many years since the Japanese 80s bust. So when we look at the yen, and I'll just take you out on time frame a little bit, it's our expectation in the longer term, technically, that this is quite an uncomfortable situation that the dollar finds itself in. And there's quite a rounding out here over here, and we're quite familiar with patterns like this. And we tend to expect something like this, and I'll just change color and say, you're looking at probably one of these double-headed waiting for a final shoulder, and then a meaningful reversal at the 140, 141 levels like that. And that would see us expect a break down to the downside. That's going to be a real problem. This, by the way, was the small shock wave, relatively, although it didn't feel like it at the time, in the August of 2024 period on the USDJPY. That was quite a meaningful slapdown event. And it gave people quite a fright. And then they put it on the ice and they said, hey, you see, it's almost back where it was. Forget about it. But it wasn't held up for very long, and it came down to that 140 period. So right now we're in an uneasy region of the USDJPY where it is being kept marginally. You can see the buying coming in there. You can see the buying came in its support there. This 140, 141 range on the USD JPY, which typically represents a fear index, particularly with reference to the funding on via the capital, the cheap capital of Japan, and the carry trade. So for me, this breaking down would be very bearish for the S&P, the MAG 7, potentially treasury bills. It would be repatriation by Japanese little old ladies for their pension. And that was starting to get discussed. Everybody, and I was saying our worst YouTubes, we did a couple of them, and we don't care if they get lots of views. If it's a financially important point that needs to be spoken about now, we do it. And we had setups for upside on Japanese debt, even when it was at 0.25 on the 30-year. We did charts, we showed upside HVFs, we said you could do 1.55, you've got another setup later, we did it again, you could go towards 3, and next thing you know, in the previous 6 weeks, so this was a year and a half, 2 years ago, everybody on X was suddenly talking about the long end of the Japanese interest rate environment. And it was becoming too obvious. So having had the treasuries devalue, what was now happening is the funding nation was devaluing their treasuries too, a large amount of which is held by the Bank of Japan, but nonetheless they're in pensions for Japanese people who are an even more extreme demographic than American boomers event, and they were losing value. And it started to get disorderly. The rates were getting higher. And the problem you have with the rates going higher is that the closer Japanese rates get, long end rates get towards matching US long end rates, either the US has to start increasing rates, in other words, their debt has to start devaluing immensely, or the carry trade, which was giving this nice fat yield differential between near zero call it 0.25, 0.5s borrowing, and what they were paying, that whole trade starts to come into question. And it starts to unwind. Typically, there's intermediaries that put margins on, so it's not all profit. When you're dealing with investment banks, they like their pound of flesh too, you know. When you just say, hey, I want to borrow, get me a loan in Japan on a cheap deal, and then, you know, convert it to dollars and allow me to invest somewhere else. That doesn't come cheap. Everybody has to be paid. And this structure overall points to a not too far away event. But I think before that event, we make this right shoulder and the USDJPY potentially has a go up to the upside. But it doesn't have to be long. It might have already made it in this move up to here, because so in the troika, because I mentioned three currencies, I'm talking about the dollar, the most vulnerable one in our opinion, the yen, which is the funding mechanism. Some will say, why is that not more vulnerable than the dollar? No, America's the hegemon. They're the one on the 26 rung ladder. They fall the furthest. And when you take unfunded liabilities, it's always been my view, the manner in which Japan has been a cheap wholesale funding mechanism, you're actually going to have a problem of yen strength when you underwind and when you undermine the carry trade and you reverse it. So overall, we're watching this very, very closely on a short time frame, because we expect this to head down. You may remember after the nuclear crisis of 2011, Fukushima, in actual fact, a new, out of the blue, Abe got put in. Now, that was a long time ago. He's since been assassinated. It's quite foxy what's gone on here, quite a peculiar assassination as well, that warrants a lot more investigation as far as I'm concerned. I mean, when last did you have a first world major nation's prime minister assassinated? It's pretty bizarre. I can't tell you what happened. In truth, I don't know, but I consider it bizarre, and I think there's answers not that haven't happened. But that was a whole bunch later. He came out of the blue, having served once before, and suddenly took over. And that was during a period the yen was strengthening, and he brought in Kuroda initially as his Bank of Japan head, and they went about the three arrows policy, which involved chronic devaluation of the yen. You've also got to listen to Professor Werner, who actually tells you on financial matters, America owns the Bank of Japan in terms of major decisions and rulings. And the problem was the yen gaining too much strength, too much cheap borrowing, where the yen strengthening was unwinding the casino in America. So he went on, I'm going to double in 18 months the currency. This is the point at which the yen turned, and everybody started beating up on Japan and thought they were so smart about this rotation here. So the Fukushima was near the lows. You got a new government in because of that crisis, and that's what then transpired, the weakening of the yen. Now, a key warning, this particular chart with CMC markets is not giving you much history. This chart comes from all the way up top there. For the pound, at one point, the pound was 686 yen. It's down at about 180 or 90 or 200 now. And the same applied for the dollar. The Japanese won the peace period after World War II, and their currency got very, very strong. And I'm here to tell you technically, on the big time frame, you should look at big time frames, that is not a good technical structure. We're almost certainly on balance of probabilities. When you talk about the future, you can never speak absolutely. Calling at least a localized high there for the USDJPY, failure to make a new high here, and major rejection hammers, inverted hammers that are not being able to trade much higher here. That tells me the conveyor belt of cheap funding being put on the conveyor belt, funded and sent to the casino in Mag 7 and Treasuries in the US is not operating nearly as well, and that there's likely to be a disorderly event of downside here. And people have got to be are sleeping on the carry trade threat. They thought, that's it, we did it recently, you know, that means we've released the pressure, it's no longer there. You didn't let the whole thing play out, even for 5% of what needs to play out. There is long-term borrowing at super cheap money that has turned into a funding mechanism of capital that has been tied up for ages, pushing the casino, the unicorn, the Mag 7 that America runs. So think of it as a casino and a cheap lending environment that has been the perfect mechanism. You and I haven't got, during all the good years, the chance to borrow like that. We're not institutional. We don't have hedge funds and intermediary brokers that can facilitate that. I once had a UK home on a Japanese currency mortgage, and I paid quarterly about 2/3 what I should be paying monthly in pounds. That's the value of that on a property that I would developed out quite substantially thanks to the cheap funding. So, we weren't invited to play there. We could have put it in that was in the 2000s. We could have put that kind of money into the NASDAQ and the tech stocks, knowing that we're developing the surveillance finance world, and we could be incredibly rich on borrowed money. The problem now is we're at what they call the fag end of the cigarette. And I think there's going to be a major move to the downside. So I've gone long Swiss franc, Japanese yen, medium term. Longer term, I'm deeply concerned about yen strength. And that's why I took it against the Japanese yen. We had, so we're going back, I'm joining all the narratives. We trade technically, but the story comes that everybody loves, because everybody loves stories. I call it story time with Uncle Frank. People don't trade if they don't have a story. We trade technically, but that was your setup. And that setup did have a blow off to target, which has just completed. However, we think there's more, and that's the only reason we're still long. But I'll just highlight that gap, exhaustion gap, that technical people will notice as you approached our target. Absolute gap onto our target, blow off, and a dip down. Now, the only reason we're still long and haven't closed is because on an even bigger time frame, we think there's more to come. So this is how you multiply your way to wealth, and that's using technical charts with squeezes. We're now on a weekly time frame, and we see this whole pattern like that, for which this is the one I was showing you earlier that's led to this breakout. So we think there's a run up to 190 on balance of probabilities, given this squeeze. The Swiss franc has been killing it against the yen, but patterns can fail. And if the USDJPY suddenly reverts in a manner that I'm not comfortable with, so I want to take you back to the USDJPY here. If that reverts too strongly down and starts running these lows, I'll cut and run out of my long francs, because I would expect the yen to be powerful, and I would pivot to a Swiss franc USD, and you could even put on a short on the USD JPY, given the structure, the very head and shoulder. I mentioned it's a double head. It's like a Batman head with ears and two shouldering. So there's a couple of FX trades that are going to be showing the pressure of the tensions of how the world has been made up and how America has had cheap funding at the expense of Japan. And there's quite a lot I've said there. So once again, I'll return to you.
Sorry to interrupt this episode, but I'd like to tell you more about what we do at Gold Republic. At Gold Republic, we provide physical gold, silver, and platinum, fully insured, fully in your name, fully allocated, in top-tier vaults, securely saved in Amsterdam, Zurich, and Frankfurt. No paper promises, just real ownership, full transparency on your name. We are fully regulated and conduct regular independent audits of our vaults, with more than 700 million euros of precious metals under custody and 70,000 investors that trust us in the last 15 years. Our top-rated app gives you full control. Track live prices, explore detailed charts, and buy or sell in just a few taps. Whether you're hedging against inflation, currency risks, or financial stability, at Gold Republic, we offer real assets to safeguard your generational wealth. Indeed, but it was also, I think, a comprehensive view about understanding the currency mechanisms here that you've just outlined. And so what would this entail for the markets more precisely if that collapse is then taking place?
So essentially, the carry trade has been a risk on funding mechanism. Risk on means everything. It means treasuries to a degree, but it means stock markets definitely. And it means Mag 7 and tech particularly. because associated with that, you're likely to see interest rate rises on the American debt. So if Japanese money that was skimming the difference, the differential, the delta differential in yields in the Japanese market versus the treasuries in the American market, what you would then see is sales in the US Treasury market converting into dollars, dollars converting into yen, yen going back to pay off the loan. So that would be the reversal of the carry trade. So obviously selling off of treasuries would see rates spike. And that's why I say I don't see it yet in the 10-year, but I think it could be coming. So there's time for a medium time frame Swiss franc, Japanese yen to still work. But in the more longer term, I think this is going to become a major point of contention. But anyway, you could also see people that have bought US stocks selling them. And that's where I point to tech stocks particularly don't do well in high interest rates environments. If the American debt market is falling and the interest rate spiking, and particularly if a lot of that alpha seeking was chasing into tech stocks, of which the Mag 7 is obviously a large part, then you could see the NASDAQ coming down. So you can also watch the IXIC. That's the last thing I would watch, and I would just look for a timing event if I was looking for a short. At the moment, as you can see, the end of the war and the price of oil and stocks has actually given it a bump to the upside. So it could well trade past the higher highs, because I don't think this is immediately. As I say, I still feel we've got a medium-term event. In fact, you've got a bit of a reversal structure here. Let me go a little bit lower on the NASDAQ with a shoulder. Not one I'll be chasing. I tend to stay out of stocks. I'm very happy trading the major markets of the debt-based collapse. But this is a bit of a reversal. You've had a big gap up there, and you've had another gap on composite NASDAQ. I think you'll go higher and take out those highs, but you've had quite a bumpy old ride coming into that. I will be watching this. At the moment, it's all love and light, and despite this rising wedge here, you squared up out of it. You didn't break down too much. You had one breakdown, return move, you've squared up, and you've actually traded higher. So for me, it's not a short stocks, but when the carry trade unwinds, you'll start to see it reflect. And if you'll see the USDJPY strength, weakening, and you see treasuries weakening, that means the rates going higher, the actual values going down. This would be very risk off for these kind of indices. It's not here yet. So I think we've got a window where this will push higher. Our franc will push higher against the yen, but then that could all reverse. And the strongest currency could be the yen, not because of global good state of fundamental or particularly bullish Japan per se in terms of their policies, more because there's been decades of buildup of long-term borrowing that would have to rush back and make whole. Otherwise, you're going to have bank liquidations and other uncomfortable things that will take place in Japan, which would still probably see the yen end up strengthening. So I'm putting everyone on medium term, everything fine, slightly longer for the time frame. The key is going to be the 10-year. These are the 3 or 4 charts on this troika you should watch. The Swiss franc getting disorderly strong. We've already played a little bit of that here. I think it might rest, but it's going probably higher first against the yen on the basis that this is a continuation pattern. That is a continuation pattern there. And that certainly was a brilliant one on a lower time frame. This is the up move. It eventually got a little bit choppy, needed to square up. This is clearly a break, and you made a new high. So the right place to buy is franc long, but you want to watch that USDJPY. America needs the weak yen. These will break out. That's the 10-year to the upside on rates when the money has to start flowing back to Japan. That doesn't look like it's about to happen just yet. So it's getting ready. It's coiling. It's been in a holding, but that still looks like you're currently for this month trading off. So it's not tomorrow. It's not next week. It's not next month. It doesn't look like it. And then back to the USDJPY. These are the 3 charts you need to watch out for in terms of this. and I will not use CMC markets. I'll rather use one with a bit more history. This is 2 inverted hammers. You need this to stay in the range if you're America. This should be worrying you immensely, because that is topping for me. It's a topping indicator. And that smells like quite a big localized high, and I'm not sure you will take it out again pre a major financial event. So watch that. We're leaning on that 140. So if we trade through 141 and we start trading through 140, you want to be short and you don't want to be risk on. Ironically, there will also gold could go temporarily down long term significantly further, because it will lead again to reserve asset seeking. It could even go straight to going up like it did on the Iran war. It's worth bringing in gold. Tell me if you would like me to just give you a take on
Actually,
gold.
that was exactly what I wanted to talk about, was commodities and precious metals. So oil and precious metals, including gold, silver, and platinum, which we haven't talked about together, but which you've covered in the recent weeks. But let's start with gold.
Yeah, this is on the 4-hour. So first of all, we're in a macro bull market, and I will continue to say that, and I will continue to remind everybody. That means big time frames is largely up. I mean, even ridiculously long, but since 2000, you could argue you're in one long bull market. The difference is the pause period is you had a pretty lengthy period where you failed to make new highs between here and here, which some would have said, you're in a bear. By depending on your time frame of analysis, most people considered that a bear market, and I'm okay with that. Most people are on lower time frames, but since 2000, in actual fact, this is a bull market. It's a macro bull market. This is the hugest winding up pattern that we've ever had on gold, in my opinion, an ascending triangle. Of course, if we throw the CPI on there, instead of looking so ascending, it has more of a symmetrical triangle vibe to it. But this is a very fresh new bull on the macro time frame. That said, if you start dropping to weeklies and dailies, there's going to be up days and down days mixed in. You don't get all your Christmases all the time. We said there'll be some chop round about the 2.9 level going to 3,000. That was your pullback. It actually wasn't too much. And then Trump did the tariff tantrum, and actually gold shot up. So gold actually did almost too well during the tariff tantrum, and it's my take that, so I'm bringing you into the more shorter term that most people operate into, slowly but surely. If you look at this on a 4-hourly, this is probably winding up. We said, guys, this is a grind. You're going to break the red line. Just like when you were selling off, we said you're going to break this red line to the upside. So that was a downward biased megaphone over here, like that. And you broke it to the upside. But this is all part of, much like the Treasuries. And I want to remind people, the trade is dump Treasuries, buy gold. Treasuries are gestating with their yields quite close to the high, but coming off. Gold is gestating and winding up with gold quite close to the high, but coming off. Exactly as we predicted on that red line. There was someone who was saying it's about a breakout to the top. We said, no, you don't grind upwards like that and then suddenly break out. You're winding up. On balance of probabilities, you're winding up. So this is a longer process, but as I've already said, the UST's rates move through past the 5% and making new highs will also be a longer process. So if I just get a bit more real estate, these are all typical technical structures where I would expect it to do. Essentially, you've done that. I would expect that. I would expect that. I think you need a down leg, and I think you can come a little lower. You could do this, and then you could do that and that. And then we all want to be in the trade. And we gave one of these winding up opportunities to a lot of gold channels where we appeared, and on our own Market Sniper, that Market Sniper YouTube channel, when it was right down at 2,000 earlier. And we gave quite a few along the way as well. Here's another, jump on in, have largely upside. Boom, makes the target, pullback. Then another wind up at the target. Okay, get back in here. Boom. Another key move. This was on quite a small time frame, but the original one was actually go back to the daily time frame, right the way back down here. And we said, everybody, there's rare moments where even if you're not a particularly great trader, but you can know how to set a stop loss, you're going to do pretty well, even without having great skills. This is a unique setup. Get long here. We still have that original risk reward in there. It was massive. And you could have had your stop. You could have got in early on that, your stop there. We were putting in entries there, and it kept on trucking, and there it is. That's when it made the target. And what did it do after the target? Chronic pullback. Okay, not that chronic in terms of the long run, but if you were on leverage, it would have been a little bit uncomfortable. It would have been like that period as well. So my expectation is the next version of this is currently forming here. There. I'll try get them both on screen. It's a little bit of a sketchy effort here. We're on the daily time frame, but it's going to be a bigger version of it as well, which usually means the bigger the setup, the bigger the move. There's a proportionality. So we gave this breakout. This was an excellent time to go leverage long if you know how to manage a leverage trade, and you definitely an investment. And I think you're going to be getting something along the lines of that. Just by the way, the geography, the geometry, not geography, 3.5, and that went down to, what was it, around, let's get a number for you. The pullback to its absolute low was around 3,120. So that's about $380 worth of upside geometry projected, I would expect, from about 3,350. So you put 350 on 350, this will take you to 3,700s. And ironically, we will have, for other technical reasons, a target at 3,694 out of this move here. So this is what I love about technical analysis, when you get agreeing opinions for different geometric reasons. So that's a pole from that low pullback to that blow off. And this is all a continuation pattern. That also brings you to 3.7. So I could see 3.7 being the gain out of a leverage long trade that could come out of this winding up process. So that's quite an important and exciting time. What it does mean is, though, there's not much good trading to be done for a bit until that's ready. I think you still need some time. You need, it could even be 2 months, it could be 3 months, it could be 3 weeks, it could be 5 weeks, 6 weeks. It depends how fast things happen. If it were to come really hard and then snap back really fast, you could be and then have a minor pullback. You could have quite an ascending structure that could be breaking sooner than we think. But it points to 3.7, and remember, you normally beat the target. So we called for 2.9s, 3,000 from way back here. We said you're going to run the next 3,000. Before you had this turnoff, you actually traded as high as, so target should be beaten. The high before you dip below 3,000 again was on that candle, and it was 3,167. So having called 2.9s, 3,000, you went $167 beyond before you had the first snapback, pullback of real strength, which brought you back to 2,956. So you should make 3.7. It could go 3,805, for example, and then come back to 3,500s for a bit. That's how markets move. Price behavior is a fascinating topic.
If we look at now platinum, how do you explain it high, and how do you also characterize the nature of platinum in that context, in the big debasement that's happening right now? What does it say?
So the amazing thing about gold's move is it's the most monetized and noble metal out of, I would say, out of all of them, and it's the most accepted. But once you've had major moves in gold, actually the Chinese market is a fan of the white precious metals for coloring reasons, I'd imagine, and for wearing in terms of jewelry. And if you get a gold platinum valuation that is deeply one-sided, and I'll bring that chart next, but I'll just cover the platinum chart. This was a terrible decade from this event here. It never made the high. This was its last peak moment at about 2,300. As I've said many times before, I've known platinum, I've been around, and it's been a premium to gold. What ended up happening is you had this green agenda, which a lot more people are questioning more vigorously nowadays. Your diesel engines, catalytic convert, diesel bad, everything went palladium. We've shown the chart with platinum and palladium on it. Palladium absolutely mooned during this period and has since sold off with the green agenda. It's having a bit of a capitulation at the same time during this period. And what's happened is you broke out of this falling wedge over here, and then you went straight up into a coiling process. So we were sitting in this a couple of times. We actually got washed out. We had shorts on that tweezer bottom. We got washed out back there on that final, and it's quite common. A market has a flush out on one side before running the other way. And we know that, but we still got caught. It went further than we thought. So we ended up buying back in around here, but we ate some red on that. But we've made it all back and spades since the breakout, and that is typical. This is a big technical breakout, and our core view is you are more than going to surpass the previous high. In fact, I've got insane numbers. If you think gold can go at some point to 20,000 as part of dollar debasement and devaluation, let me tell you, platinum can go 35. It can go back to being near double 80% of gold as it was many times before. So that puts it as a super outlier. Some people have tried to take me on and say silver's more undervalued. And I love silver, and I'm a massive silver bull. So it's like telling me which is your favorite son in effect. But when you put the last 20 years of price behavior between all the metals, and I've done that chart, that zero, they all start from the same point. Platinum was by far, until recently, and still is, and so much catch up to do, the most undervalued. So all the others were higher, and I can tweet that chart out again. I need to do it again, actually, since this big move. But platinum has 100% lagged silver. I think from its all-time high, it's still 52% down. It's at about when I did that chart. That will have changed a little bit. Silver is at, say it's at 36, and its all-time high is 50. It's not quite the same degree of undervaluation for the 20-year period. And just to further hammer that platinum, I suppose, nail home, I want to also show you versus gold, which is, of course, the biggest. The king moves first. He doesn't run fastest. He's the old hand. But if you just have a look at this chart, I'll de-log this. Normally, I say you should be in log scale for long-term charts, but I'm just going to leave that one right there with you on a de-log basis. And that takes you 20 years back, 2005, for platinum's relative valuation. So platinum has been, and I will tell you, my childhood, 80s and 90s, that aren't even being captured here, aren't being reflected, and I was used to it being a lot more valuable than gold. But if you look at it, it's been almost 2.5 times gold by valuation before. If it returns there, where does it go? Well, at current prices, let's say 3,500 again soon for gold. It's probably 3.3 at the moment. But if you go 2.5 times, you're talking 8,500-ish. So it's chronically undervalued. It's currently at 0.39. And we think this is a lengthy trend that will continue to give great solace to platinum holders. And that fact that it can go to beyond gold, it's a very thin market. So when you get this market right, gaps are all in your favor, generally. Not universally, you can never say anything absolutely about the future, but gaps are generally in your favor, and you're looking at multi-decades devaluation and entirely fundamental economic and industrial use case. This is an incredibly rare metal. And 75% comes from where I'm sitting, South Africa. And the next in the mid-teens is Russia. The rest of the world want platinum. They're buying Russian or South African. Canada, all the others are rounding errors, single digit and rounding errors by comparison. You're talking about 89%. When I talk Southern Africa, South Africa, I'm talking also the lower part of Zimbabwe too. The Southern African, Zimbabwe is about teens as well. So it's huge. It's very narrow. And platinum mines are the greatest unloved of all because their price has done worse than silver in terms of devaluation. Look at this relative devaluation to gold, and also look at the price. It's done worse. It's much harder to find than silver. You know, some of the biggest silver miners are zinc and copper miners. You just don't get people say, hey, I started a zinc mine and look at all this platinum I'm pulling out. Hey, I started a copper mine and there we go. You just can't get away from it, bumping into big fat seams of platinum. Sorry, mate, that isn't happening. So platinum is incredibly unique. And it would be my case for absolute outperform here. People can talk about rhodium and some of the other one, they're a little bit smaller. Those are very thin markets. I'm not sure whether it should even be considered, but these guys are the winners, and it's the most undervalued. So I really like platinum.
And what about silver? We've seen also there like some really silver prices going up to I think $37 an ounce. How do you explain that? You've also talked about the gold silver ratio before on our last episode, that people shouldn't jump on that train too soon because you still expect higher ratios there, and that it's too soon for the silver play.
I won't say it's too soon. I still buy silver. I would say let's say platinum is too bizarre for you and too eccentric, or you're in Europe and you don't want to pay VAT. I still think you'll cover that VAT cost and some, providing you hold long enough with a multiple it could get to gold. But let's just say you just don't like that, and it's just about gold and silver for you. Most precious metals accumulators are like that. They don't hold platinum. The warning I've given is people are over presumptuous. This was supposed to be the move all the way back to 30s and 25s. It didn't happen. This was it. It had overtraded. That was supposed to be the move down to double digits. It didn't happen. It got held in a containment space. Eventually it will, but this is a cry wolf situation. You'll be wrong 10 times before you're right once. And I'm just warning people of that. I thought this was the beginning of the move. We saw this grinding. I thought that could be it. It could be it. We could finally be about to break the 75 and most importantly, the previous low, which is just below 65. Those two levels. That's the beginning of, going to possibly 10. And I think for all those that in your comments will go, he doesn't appreciate silver. He doesn't know how rare it is. Blah, 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 blah. I, in the end, think silver goes single digit gold silver ratio. I think you can dip below 10 when we have the full. The key point I'm making is you've got to have a political and economic absolute crisis. You've got to be in the peak crisis. Everybody understood CV19, lockdown, close your business. That was literally it. Everyone was like, holy crap moment. That's your holy crap moment, and that's when you have the highest ratio for gold silver. We are waiting the next economic crisis, and it's already here, but it's not at its peak moment. It's not in the, okay, everybody, you've got to stay inside your home. Amazon will deliver what you want to buy, close your business, and don't make anyone, the granny, sick. We haven't had that moment for this current economic crisis yet. And when that happens, silver gets sold off. And it gets sold off worse than gold because gold is the king The central banks won't be selling off gold when that moment comes. They probably even have the day, date, and the lunar candle for when it's going to come. They'll be buying on the dip when it happens, and gold will dip far less. Because it's the king's money and the big people's money, the elites' money, I don't like calling them elites, I don't think they're elites, but the orchestrators, it's not selling off near as much. Silver, because of the industrial component still part of it, we're going to have a moment where there's no more ordering, there's no industrial capacity again in some degree. Debt-based collapse, bank-based collapse, pandemic Mark II, geez, list all the possibilities, but there's something coming for an untenable system. When that happens, you actually get an out of the blue, what looks like an out of the blue, blow off to the upside on the basis that everything gets sold. Everything that isn't nailed down gets sold. You're going to get a liquidity squeeze. People are going to be caught without cash. Iran went and zeroized our bank balances. We've got to go bomb them. They did this to us. We don't know how much money you had in your bank. Sorry, we'll give everybody an equal UBI. I don't know. Create a drama story of your own choice. No one is a master for that. There's many that have been seeded as potential. But when that happens, I think you get peak crisis moment. And I've said you could get it higher than the last time, because this will be the crisis to end all crises. Many people go, how do you get higher than shutting everybody's businesses down? Believe you me, it's possible. It is possible. Debt-based collapse and all the banks zeroizing your money is something you didn't get last time. That could do it. So there is a potential technical signature for that, and that's where I got the values from. And it's quite natural to have a breakout and a return move before you shoot up. And again, I refer you back to the first part of this discussion. Not yet for the unwind of the carry trade, but maybe not so far away. Medium time frame, I think we're going to muddle on. But there looks like a real USDJPY crisis. Not yet the gold, the upside break. Not yet the rates, the upside break. They're perfectly synchronized technically. They both need to wind up, and then they're ready to go upside. So I feel we've got the directions right. We keep on keeping on. We keep making money and getting endorsed by the markets. Don't stop doing it until the market gives you an alternative feedback. So in that sense, the peak crisis of this economic recession that I'm convinced we're already in and have dipped in and out of for quite an extended period, which will probably only be retrospectively acknowledged due to fake unemployment numbers, et cetera, is still to happen. And when that crisis happens, the gold-silver ratio can work against you. So stack the gold into the blow-off, keep stacking because of unobtainium silver. But my model, this is not advice, 75% gold, 25% silver. I'm actually stacking platinum, and I've reduced the gold component to allow myself to do that because I'm a massive believer and have been for a while, and now it's endorsed that view. But, it's better to buy if you're in the North American side and you're not being paid a tax. But I still will feel the platinum will dip more on a thin market than gold, but I don't think it will dip as much as silver in percentage terms, because its industrial use is probably not, its desirability versus its volatility that the silver gets is probably lower. So its BT is lower. So with that all said, just be wary of everyone's pivoted. Oh, you should just be buying the silver now, and that it's all happened. And I'm just saying, really, that's your base case. We made 100 and we pulled back. Well, that's not quite good enough because we've made 100 before and traded 125. And the crisis that is coming in some way at a financial level is bigger than CV19. So it makes sense to be a little more circumspect about whether this is all done just because of two red candles. You had 3 or 4 red candles here. It wasn't done. You had 3 red candles there. It wasn't done. You had a bunch of down leg there. It went higher. You had 2 red candles there and a hammer at one point. It wasn't done. And even the big rejection eventually, once you've done a blow off, did end in 2021 and actually wasn't allowed to play the whole way through. So the main collapse is yet to happen. Until we get 30s on the gold silver ratio, 35s, and And I say my target is actually in an overreaction sub 10 for a day. It might just be for a day, a week, a month, like this was. You'll get an overreaction to the high side. You'll get, in the same way, an overreaction to the downside. We haven't had the whole story play out, so we're still waiting. That's my take.
Thanks, Francis. I really appreciate your time as always, your precious insights, your fresh insights, because I think there's not two Francis Hunts in the markets, and you always have unique insights, especially on the topics we've covered. So one more time, thank you, Francis.
Absolute pleasure. People who want to engage, the Market Sniper YouTube channel is your first point of call.
Exactly. Make sure to subscribe and follow Francis on X and on YouTube, where you also deliver weekly updates on video and obviously your daily tweets on Twitter. But again, thank you, Francis, and I hope to talk to you soon.
All the best.